Hey traders, this is Yanis from EFX. Today we are going to tackle a very important subject, which is leverage in Forex. Leverage along with margin are probably the most important concepts related to a trader's account. Both concepts are closely related, so we'll talk about both of them today, but one thing you need to remember or to learn if you don't know it yet is that Forex accounts are often referred to as margin accounts, and that's for a very good reason that we will analyze in the next slides. Despite the huge importance, it seems that these concepts, margin and leverage, are either ignored or misunderstood by new traders, and unfortunately also by seasoned traders as well. In terms easier to understand, leverage, which is provided by the broker, gives traders the advantage to controlling a much larger position than they would otherwise be able to if they couldn't use the leverage. This allows them to potentially make greater profits if their market view turns out to be correct. Of course, the downside of the use of leverage is that trading risk is also magnified by the same amount that your profit potential will be increased by using leverage. In other words, leverage can allow you to make bigger profits, but also much bigger losses. Leverage is usually expressed as a ratio between the amount of money you really have in your account and the amount of money that you can effectively trade. It's usually expressed in a format of X to 1, like 20 to 1, 50 to 1, 100 to 1, 400 to 1, etc. At this point, let's do a quick refresh about the relation between the lot sizes that we are using and the amount of currency, the amount of units of that currency that we actually trade when we are opening a position. So if we are using a standard lot, that's the equivalent of moving 100,000 units of that currency, and the value per pip is $10 per pip. Okay, so if using one lot we make or lose 15 pips, then the amount that we will gain or lose will be $150. Then we have the mini lot, which is 10,000 units of that currency, and the value is just $1 per pip. So trading 0.01 lots or one mini lot, and again making or losing 15 pips, is the equivalent of $15. Last, we do have the micro lot, which is moving 1,000 units of that currency, and the value per pip is 10 cents. So if we trade 0.01 standard lots or one micro lot, and we make or lose 15 pips, then we will be talking about gaining or losing $1.50. Okay, so what's important to remember here is the size of the unity that we are trading. So for example, if you wanted to trade one standard lot of the euro dollar without any kind of margin or leverage, since one standard lot allows you to trade 100,000 units of that currency, then you would need $100,000 in your account to trade this standard lot. Now, with a margin requirement of just 1%, for example, given to you by your broker, then you would only have to deposit $1,000 in your account to execute this same trade. In this case, the leverage provided for this trade would be 100 to 1. So leverage in Forex is calculated very easily. It's the purchasing power that you have, or the units of currency that we are trading, the lot sizes. Okay, one standard lot is $100,000 divided by the money that we have in our account at that time, which supposing that we fund our account with $1,000 is $1,000. So we would be using 100 to 1 leverage. Okay, and this translates as following. For every single dollar that you deposit in your Forex broker's account, then your broker in return deposits $100 in your margin account, in your trading account. So if you deposit $1,000, then the broker will deposit $100,000 in the same account. Obviously, this is not precise. This is not what's going to happen. If you open an account with $1,000, you will not wake up the next morning having $100,000 in your account. However, the broker allows you kind of like a loan to trade $100,000 despite the fact that you only have $1,000 in your trading account, okay? So basically, leverage allows you with just $1,000 of your own money to control and trade $100,000 for your trading purposes. That's how leverage is created in Forex. So once you know the margin percentage, which is something, it's a number, it's a percentage given to you by your broker, you just multiply this with the trade size and you find the amount of the equity in your account that is needed for you to open that position. So for example, if we have a margin percentage given to us by our broker who says, okay, I need at least 2%, okay, for you to open a full standard lot, a full lot or a standard lot size, which is 100,000 units, okay, then you multiply 0.02, which is the 2%, by the trade size, 100,000 units, and that gives you the amount that you need to have available in your account at that moment. So if, for example, you want to trade 3 standard lots, then you multiply 0.02, which is the 2%, with $300,000. That will be your trade size overall. And so you would need at least $6,000 in your trading account. Now you can also calculate leverage very easily. Okay, it's the trade size, the 100,000 units of currency that we are trading, divided by the equity, which is the amount that we have in our account. Okay, so if I do have $2,000 in my account and I'm opening a trade with a 1 standard lot, 100,000 units, then I'm using a 50-to-1 leverage. Let's examine a scenario, okay? Why leverage is very important, and you must with a capital M know and understand how to use leverage and margin, okay? So let's suppose that we have 2 traders, trader A and trader B. They have the same account funded with 10K. Trader A, using leverage, buys 50 lots of the Aussie dollar, okay? While trader B only buys 5 lots of the same currency, of the Aussie dollar. So here's the question. What happens to trader A and trader B account equity when the Aussie dollar will fall and they will lose 100 pips in that trade, okay? When they will be 100 pips in the red. So here's the answer. Trader A will lose 50% of his account. So he will lose 5K, $5,000. At the same time, trader B will only lose 5% of his account. Okay, so look at the numbers. Both of them start with 10K. Trader A is much more aggressive and he wants to use in his advantage the leverage that he can, all the leverage that he can use. Okay, so he's buying like crazy and he's buying 500,000 currency units. At the same time, trader B is much more conservative and only buys 50,000 units of that currency. Okay, so one uses a leverage of 50-to-1 and the other one only of 5-to-1. So look, both of them losing 100 pips had a huge difference in the impact of their accounts. Trader A, who used an excessive leverage, is losing half his account just with one trade, so he's losing 5K, while trader B only loses 5%, so he's losing $500. Okay, so trader A remaining equity is 50%. From the 10K now he only has 5,000, and trader B has 95% of his initial investment. Okay, so by using lower leverage, trader B drastically reduces the dollar drawdown of 100 pip loss. And by doing that, he avoids what all traders fear the most, which is a margin call. So what causes a margin call? Margin call is what happens when a trader no longer has any usable or free margin. In other words, the account needs either more funding or you need to close your trades because your losses are accumulating, and by accumulating losses, open trades, okay, they are eating up your available margin. So that tends to happen when trading losses reduce the usable margin, like I said, below an acceptable level, which is determined by the broker. So a margin call is more likely to occur when traders commit a large portion of equity to used margin, leaving very little room to absorb losses. From the broker's point of view, this is a necessary mechanism to manage and reduce their own risk in an effective way. So leverage is often and fittingly referred to as a double-edged sword. The purpose of that statement is that the larger leverage a trader uses, the less usable margin a trader will have to absorb any losses. And in this case, the sword only cuts deeper if an over-leveraged trade goes against the trader, as the losses can quickly deplete their account. They strip the account, they zero the account. Here are the major causes for margin calls, okay? You can have a margin call because you're holding on to a losing trade too much. And by holding on to that trade, you're needing more and more margin, more and more equity available, which you don't have. Over leveraging your account combined with the previous reason. An underfunded account, which will force you to overtrade with too little usable margin. And this is one of the major mistakes new traders do. They don't have enough money. Okay, so they underfund an account. Obviously, you can trade and do well with a $100 account. But if you are underfunded and if you open an account with just $100, here's what's happening most of the time, if not all the time. Okay, because the amount is very small, we are eager to make more money. We are trying to double that amount as soon as possible or even triple it, okay? And by doing that, we are using as much leverage as possible, as much leverage is offered by the broker to try and maximize the profits. But remember what we said at the beginning, maximizing the profits, yes, but you're also maximizing the losses, okay? And as we saw, using a very, very big leverage and a very big lot size leaves you basically in the red, okay? Leaves you under a danger of having a margin call. And obviously trading without stops is the last thing that any trader should do. There are a lot of traders using mental stops, but not hard stops. So if things go wrong fast and very badly, they will be caught on the wrong side of the trade, and that will bring up a margin call. Okay, here's a very interesting table that I'm always showing to all the traders, and I would like you to have it, as a post-it or as a note, side note, near your monitors when you're trading. Here's the issue. When you lose 30% of your trading capital of your account, the problem is that you don't need 30% to make it back to where it was, but now you need 42%, almost 43%. And when you lose 50% of your account, then you don't need 50% to make it back to break even. No, you need 100%. Remember, the trader A lost 5K out of a 10,000 account, so his remaining equity is 5,000. So from 5,000 to get back to 10,000, his initial amount, he needs 100%. He needs another $5,000, okay? So keep those numbers in mind. They are extremely important because what they are showing you is that the more you lose of your trading capital, the more difficult it will be to make it back, even to the initial amount, even to break even. So many traders do not understand what leverage and margin represent and how they can be used to their own advantage. Leverage can have disastrous results. We saw them, and it's one of the major reasons why accounts are blown up, because leverage and margin are ignored. However, at the same time, leverage can also be a very good tool for a seasoned trader because it will provide opportunities for extensive profits if it's used in a good way. So I hope that I have explained both concepts of leverage and margin in such a way that you have now a much better understanding of them and that will allow you to use them wisely to your advantage. Thank you for being with me during that presentation. I hope to see you in the next one. Take care.